Hello, we're coming to you today on September 20th, and we're going to see if we can wrap up our series. This will be the fourth in a series of videos on using market structure to create a trade plan with specific strategies and tactics that are going to be evolved from our combination of charts and very simple parameters, which we've talked about in the first three videos. And while those videos gave you an idea of how we sort of put it all together and the theory and the logic behind it and everything, but today I'm going to try to get right down to brass tacks, exactly where I put my orders and how to execute them and how well defined they are and how they're based on very concrete patterns and concrete combinations of variables that we develop the ability to recognize day in and day out so we can have consistent action in our trading and be profitable over time because we have a significant edge. If you combine them in the way that I've done using the foundation of what I covered in videos 1, 2, and 3, then today you'll understand exactly how something as simple as trading off of support, which is from broken resistance earlier to the left of the chart, that can become a very objective key that my trade selection can identify. I can identify that and act upon it consistently because I've watched it over time and developed the ability to recognize these things very, very quickly. And of course, if someone watches these videos and you're a little confused, feel free to ask me questions. Like I said before, I have my contact information on the blog. You have my phone number right there. And you definitely should go and look at the earlier blogs that I created from going back about almost 10 years ago now. The two blogs, one started in around 10 years ago, another one about 7 years ago, the second one. You can click on these links on my current blog and go back and learn all about market profile and ways that we use principles of market profile on regular bar charts. But now we've taken that to another level of where I believe I can get all of my market profile information from just looking at a chart, and I add on the training wheels of the pivot, support, and resistance numbers, which are generally identifying the same kinds of ranges and patterns of behavior in price action and volume. That these kinds of clusters that I'll be showing you in today's chart examples are really going to be forming in the exact same place that market profile indicators would identify, but those are much more complicated indicators. So basically my quest has been to simplify in order to have very actionable decision-making steps that come up and where I see them day in and day out, and I can put a trade on and take it off. And I generally prefer to trade extremes, but it can also be used, we'll see today, in the context of a trend of several, say, lower lows, lower highs on a market that's going down, or higher lows and higher highs on a market that's going up. We can trade those too. So let's just jump right in now. Don't forget to look at the warnings on my blog about trading being dangerous and you have to know what you're doing. And I'm just an educator. I'm not giving anybody the Holy Grail or anything like that. So what we have on the left, the 2-minute chart, on the right, the 125 volume, and all we're using in terms of indicators on that 2-minute chart is a period 34, 36, 39, somewhere in there, maybe like one as short as a 26. And that one moving average can provide us a lot of information, such as I want to buy it if it's above it, and I want to sell it if it's below it. But I want to get in at points of support and resistance, so that's where the pivot levels come in. So you've seen all of that, and I strongly encourage you, you won't understand today's video unless you look at the first 3 videos in the series that have all been in the made in the past week. Okay, so here's what we do. We got our shorter time frame. We've got very, very clear, objective, very easy to read signals developing on this 2-minute chart. And what I'm using is the very well-known, almost universally known principles that went way back to Gann. You have pivot low of a swing, pivot high of a swing, swing to a new low. That's the market going down until proven otherwise. Well, once it regains this area of trading, like it did right here, then that means this may be an extreme. Not saying I'm guaranteeing it is, but it may be an extreme. I start to look to go long. And the thing about using one time frame is a lot of times if you don't act right away, you miss the boat. And that's not just once in a while. It's going to be really hard to catch trades for a lot of people if you're defining something that's really like a needle in a haystack. So that's where the shorter time frame comes in, because let's take a look where I have this triangle here, and this is just from from today's trading. Today's Monday, and you see this arrow here is right before it's going to break back above the pivot for the day. Well, and that's happening around 10 o'clock. So we come over here and we look at the same place on our shorter time frame chart, the 125 volume, and we see that over here the moving average is already crossed up, and just to get that little poke through point on a 2-minute chart on the 125 volume, we had attempt number 1 to break the pivot, attempt number 2 to break the pivot, attempt number 3 to break the pivot. Well, why didn't it go down? I don't know why, but I'm just reading these simple indicators, and I got my moving averages here. The short term's above the longer term. So this is actually support as long as it's cruising above. The short-term MA is cruising above the longer term. This is still something more to be bought than to be sold, and all I got to do is maybe take 1 or 2 more battering ram attempts and it'll get through. And that's what happened. So on the 4th one, another Gann principle, by the way, 4 attempts at a higher low is usually forecasting a big breakout. Big is all relative. When it's a 125 volume chart, that might be from 404 to 430. So all of 9 points. That's a really good swing. So in that way, you can see, look at all the time you had and the ability you had to make up your mind and get ready to pull the trigger as soon as you saw the market telling you that would make you more confident that it really is holding the pivot and it's ready to go to the upside. So that's our market profile principle. Rotation, followed by a probe, and then followed by a break and attempt to go up and see if they can establish value at a higher level. In this case, it was just a spike, and before you know it, they were right back down in the earlier value area. So this is the idea of how the second time frame can make it a lot easier to get on trades, and also to always have less risk. If you're going to put a stop in, you can put it down here somewhere, and not be risking an inordinate amount when you look at a swing that gave you 9-10 points. So let's see. Let's look at a couple more examples of these simple market structure trades. One of the things we're always using is support broken becomes resistance, and resistance broken becomes support. So these arrows here, 10:56 up to the second one at 11:15. So let's look at those time frames over here. Here we are at 10:56. So they probed to see if they could take out this high and get back above the pivot for the day, and they got slammed. So this was an attempt to get out. An attempt to break out that was slammed to the short side. Now, again, the support, the pivot level that had been support is now resistance. So that's one of our trade patterns. That's where we like to get in. When the market's underneath that yellow moving average, It comes up, it retests a support that's been broken. That's a trade that'll almost always get you a pop. And that's what we'll take every time we see it. Support, broken, resistance trades are great. They work a very, very, very high percentage of the time. So here's the last pivot before this attempt to break. Right before that probe, it was right here. And that level to the tick is where it hit. And then we're getting short. Now, down here, double bottom. So we're now saying I'm not going to fade the rallies anymore. I'm thinking that maybe I'm going to regain the previous level, and then I'm going to be looking to only take long trades. So here's how that developed. So we had this attempt at 1138 up at the 805.75. This probe of the pivot was again rejected pretty hard. Now, as they come back, that retest failed again at the resistance of the pivot line. So you have a cluster on the 2-minute chart, stops almost to the tick on the pivot level, and then again the short-term bars, they let you see the trade developing, giving you a warning right here that if it was going to just be a probe that fails right off of it, then you're going to get in on this bar somewhere if you didn't have an order in a tick or two in front of the pivot level. So this is what we're using, combining time frames. And now this is another pivot of a variation of support and resistance broken and entry setups, is when it's below the moving average and it goes back above, we always look to trade the first time back. So we're seeing a couple of patterns here that we use consistently. The resistance broken, support setups. The other is every time we get a new high on a pivot, in other words, we break pivots to the left of the chart, we want to take the pullback to the MA. It's made a new high, so we take the pullback. It's made a new high, so we take a pullback. Up here, it was a retest failure. So now we want to look to start going short, and that's our basic market structure method of trading. So these are the principles that I'm emphasizing with this kind of approach to trading. I'm going to move the 2-minute over a little bit. Okay, so this is what we look for with moving averages. The direction of the moving average, whether it's sloping or flat. When it's flat, we can fade the extremes, sell the highs, buy the lows. We can take pullbacks whenever the market is extending, making new lows on a downtrend. Then we sell in the pocket if it's in a downtrend. And we look for widening moving averages. When they're getting wider, we're confident to fade swings that go into the pocket between the two moving averages. If their two moving averages are a good distance apart like this, then it's more likely you'll get a stall that you can hop onto to get in the previous direction for an extension. We look for touches of the short-term moving average. Often they'll provide good setups. You could have taken this one even though you didn't want to sell anymore here because you're regaining previous levels of support. So you're showing this final area where they're probing to set new lows, made a little head and shoulders bottom. So you don't want to be selling the rallies anymore. And here you had a regain, a perfect double bottom here. That's where you want to take a buy. So we have all of these things that we look at, and obviously I can't cover everything in a 15-minute video for you here. But hopefully you're getting the idea that what we're talking about is we have well-defined, repeatable patterns of recognition that we can see over and over and over again. So the moving averages, we look at whether they're sloping or flat. We can use them for pullbacks or to notice when we have extremes that we can start reversing, going back in the other direction. We look at new highs and lows as the basis for taking pullbacks that go into the pockets. We look at short-term early crossovers. So in other words, if I get a setup on the short-term time frame, that's what I was talking about earlier, the market, the moving averages are flattening out here. I don't want to just jump in. I want to see if I can get really good solid evidence of whether the market's going to keep going down or it's putting in a solid, if it's sort of reconfirming the bottom. When you start getting double bottoms like this, and maybe around the area of a 50 or 62% retracement of the swing off the low, whatever you like to use, but you're getting an indication here it's time to look more to the buy side. But you get plenty of advance warning with this 125 volume chart. So we looked at those first time back trade setups. Once you cross on the moving average, we jump in on the first time back. And we look for resistance broken at any time, becoming support, or support broken. So for example, down here, the previous day's close is resistance now. We're underneath it. When we get back above it, we want to look to be buying here. And that's what we did when we got a nice double bottom on that resistance that was broken that had become support. So I'm going a little fast here. You may not catch it all, but you can back the video up, watch it a few times. But these things, for me, are somebody who studied, if you backtest these things on several hundred trades, which I recommend every student needs to do that if I'm working with them, I want to see a lot of backtesting and verifying it till you just recognize it like it's the back of your hand. These patterns come up over and over again. Fast markets, slow markets. When they're new highs, go ahead, keep taking the dips. Buy the dips. If the moving averages are far apart, you can take anything in that pocket. It made a new high here. Take anything that comes into that pocket. Made a new high here, you can buy the pocket. If you get in a little early here, go ahead and scale in. Buy some here and buy some more here. Or like here, if you put an order here to go long on where it looks like it's going to be supported on the pivot and you're just too early, scale in, buy some more here. Now, of course, I'm going to have to teach you a lot of, if you haven't ever scaled before, I'm not saying everybody just willy-nilly start scaling. That's most of the teachers or the mentors, whatever they call themselves, they always say, oh, don't ever add money to a loser. Well, if it's part of your trade plan, it can be a really good technique if you're adequately capitalized, make a very, very high percentage of winning trades. But you got to know what you're doing. You got to know when to cry uncle. You got to have a plan that's strictly committed to and strictly followed. And those are the things you work with a coach for to help you develop those things which are difficult to develop. Okay, so I hope that helps. Any questions? Please feel free to get back to me at eMiniTraderPro, and I'd be happy to share with you if you have any specific questions or whatever else you'd like to talk about in terms of trading. Okay, good luck trading.